So someone in my DMs asked me a question last week, and I just couldn't stop thinking about it, the weekend. So they pretty much just said, I know exactly what I'm doing wrong in my trading, so why do I keep doing it? And I sat with that for a little bit because honestly, that's not necessarily a trading problem when you think about it. It goes a lot deeper than that. But it made me want to put it together, this video, the 5 things that I generally think separates traders who stay stuck from traders who actually start getting consistent. And this isn't any theory that I'm going to throw at you or any textbook stuff, etc. It's just the actual things that help me get consistent at trading. So number 1 is process over outcome. And before you click off this video, because you've heard this before, stay with me, because most people generally get this completely wrong. They hear process over outcome and they think, well, that means I shouldn't care about money. And that's not it. What it means for you is that your P&L is the last thing in a chain of events. It doesn't just appear. Your process shapes how you execute. Your execution gives you data, and your data over time reveals whether or not you actually have an edge. And your edge is what creates consistent outcomes. So when traders come to me and say, oh, my results are all over the place, I don't even look at their trades first. I look at their process. Are they journaling consistently? Are they following the same rules every session? Are they even tracking anything to start with? Because 9 times out of 10, the process is all over the place and they are surprised that their results are too. So you've got to fix what's upstream and the outcomes start to sort themselves out. And number 2 is risk first. And I want to be truly clear, or really clear about what I mean here, because risk management just, it gets reduced to just set a stop loss or set 1% risk. And that's not risk management. That's 1 or 2 tools. But real risk first thinking that way means that before you even pull up a chart, you know your max loss for the day. You know your position size relative to your account. You know what happens if you take 3 losses in a row. Do you stop? Do you size down? Do you keep going? Most traders don't have answers to those questions. They just have, vibes, I guess you could say. And that works fine until it doesn't. And the traders I've seen blow up, they don't necessarily blow up over one bad trade. They blow up because there was no framework underneath. It was just more so a gut feeling and a stop loss. And especially at the beginning, gut feeling isn't necessarily a good thing. And the third one is review what you avoid. And now this is the uncomfortable one that people will avoid, because every trader has a trade they don't want to go back and look at. We all do. Okay, the revenge trade after a red morning, the one where they moved their stop loss, the one where they knew they was wrong but they still took it. And because it's uncomfortable, they just skip it in the journal and move on and tell themselves that it was just a one-off. But that trade is sitting in the background and it's influencing how you feel the next time you're in a similar setup. So you're making decisions based on something you never actually dealt with. The losses you avoid reviewing just keep compounding quietly. So you got to sit with the uncomfortable ones, and that's where the real information really is. And number 4 is to backtest relentlessly. I cannot tell you how many people are out here trying to optimize a structure they never even confirmed works. They are tweaking entries, changing time frames, adding indicators on something that has no proven edge to begin with. So you've got to go back through the data first. Does this setup actually work on over a large sample size? What's the win rate? What does drawdown look like? Make it exist on paper before you risk real money on it in the first place. You cannot refine something that hasn't been proven yet. You've got to build the foundation first, And backtesting doesn't just mean, using the backtest, the replay toolbar. It also means reviewing the price action manually, going over the data, marking up certain periods of time, for example 12 to 5 a.m, what happens after the highs or the lows get taken, things like that. And the last one is screen time before payday. Everyone wants to be funded. That's the ultimate goal. Or pulling consistent money within a few months of starting, and I get that. That's fine, that's the goal. But the trader on the other side of your position has been watching price move for years. They've seen that pattern fail in ways you haven't even seen yet. Screen time is the one thing in trading that you generally cannot buy or skip. You have to watch how the markets move. You have to sit through the sessions where nothing sets up. You have to build a feel for how price behaves in different conditions. And that only comes with time. Screen time first, payouts later. But those are the 5. None of it's a secret. And all of it takes longer than you want it to. And obviously, if one of these hit differently, make sure you drop it in the comments. And I'll catch you in the next video. Take care, guys.